Welcome back. The latest bank to fall victim to the mortgage crisis, Wachovia. This morning, the FDIC, along with Citigroup, announcing that Citigroup will essentially take control of all of Wachovia's banking operations in an FDIC-assisted transaction. Here to help make sense of how Wachovia got here and where we are in the housing market overall and the mortgage market is Mark Hansen. He's a 20-year mortgage market veteran and has had a lot of proprietary research that I have found helpful in doing my job. He's the managing director of Field Check Group, and industry insiders, as well as people on the internet, also know him as Mr. Mortgage. Mark, good to have you.
Hey, thanks, David.
You've done a lot of work on pay option arms, for example, which Wachovia had in abundance. Give me some sense here as to what you think Citi should be marking the portfolio that it's taking in from Wachovia at, and whether Wachovia was being realistic at all in where it valued its portfolio of mortgages.
Well, that's the biggest problem out there right now, especially with the pay option arms, is how to value these. These are not only the most toxic mortgages ever created for the bank's balance sheets, but also for the consumer's balance sheet, because the principal balance keeps rising every month on 80% of those people who don't make that minimum monthly, or that don't make the fully indexed payment, make the minimum monthly payment, until they get to a point where they just implode. And then we have a problem where home price indexes on the banks and even the ratings agencies' proprietary modeling systems are nowhere near in line with reality, especially in the areas that have the most pay option arms. So, for
tell
example,
me about that. Yeah, tell me what you mean when the index of the housing is not in. What did you mean by not in reality?
For example, San Francisco MSA has 4.4 million people covering 5 counties. Within that county, you have Tiburon, which is down 5%, and then you have Antioch, California, which is down 70%. Values went from 2 years ago from 700,000 down to 275,000 today. It's not a big subprime area, maybe 15%. Within that area, there are prime loans, jumbo prime loans, pay option arms. So although you have a note value on a pay option arm of 550, 600,000 that keeps growing, you may have collateral support down there in the $250,000 range. So values are off much more considerably than the numbers would show. I mean, we show we're down 40% in the state of California on a median level.
That's your work that you're talking about? That's down 40%?
No, actually, DataQuick and the California Association of Realtors both acknowledge that. But the problem is, in the harder hit areas where a lot of these most toxic assets lie, values are down 60, 70%, making the asset even more shaky and making prime assets like jumbo prime loans, Fannie Freddie loans, closer to subprime and Alt-A than the original bucket they were put into when the loan was first originated, which is either prime, jumbo, prime.
Right.
So we have an asset reclassification that needs to go on across all loan types. We're talking from 03 to 07, we originated $2.5 trillion a year. So a lot of that was refinance business, but maybe there's $7 trillion in new business on the books. We have to go through those loan by loan by loan.
Mark, let me stop.
Rebucket these things.
We were just looking at foreclosure, some foreclosure tables in the state of California, which seem to actually be going the way you might want them to. Is that perhaps something that people should take solace in?
Well, yeah, we put up, that's the notice of default, notice of trustee sale, and actual foreclosure numbers. But keep in mind, most of our damage has been done so far just from the subprime, the original bucketed subprime universe collapsing. Subprime defaults are off considerably in the past 6 months, and we're rolling into the Alt-A jumbo prime defaults, and they've already filled the void. And if you notice on that chart, we're back about levels between 17 and 20 billion a month in defaults, which are a leading indicator, of course, to foreclosures.
So is Alt-A
down the road 6 to 9 months?
Is Alt-A going to be as bad and even prime as bad as subprime was?
Well, with values down as much as they are right now, again in California, there's no choice. Keep in mind, there's psychological modeling that people don't take into effect. And psychological modeling means in the past several years, or in the past several decades, if people can afford to make the mortgage payment, they make the mortgage payment. But in the past 90 years, you qualified at a 36% debt-to-income ratio, so people could save money, they could go on their vacations, and if their house came down in price, their lifestyle didn't change dramatically. In the past 5 years, we allowed people to go to 50 debt-to-income ratio, qualifying at interest-only payments, stated income, no doc, no ratio. So we're going through a consumer asset revaluation and deleveraging at the same time as a bank. Right. So how do you deleverage a consumer overnight? You get rid of that 50 DTI home, you move into a rental unit, and problem solved.
Right. Mark,
yeah.
I'm out of time here. I want it real quickly. Short answer: the bailout plan going to work?
Not large enough to cover the $7 trillion in at-risk loans made over the past 4 years that need to be rebucketed.
All right, Mark, we got to leave it there. Mark Hansen, also known as Mr. Mortgage. Thanks. Hopefully we'll see you again
soon. Thanks, David. Good talking to you again.
All right, let me send it back to Aaron.
All right. Thanks very much to you, David. And after this break, we're going to head back to Washington to talk about the negotiations behind the $700 billion bailout and the vote. Market has come back a little bit here. We're now down 251.